I'm Vali Nasser, the Dean of SAIS, and welcome back to our series on emerging markets, or as our guest would say, growth economies. So this has been obviously a very interesting series we've had today. We had the Deputy Prime Minister of Turkey and the head of India's central bank who spoke on these topics from the angle of governments. So we're very fortunate to continue this conversation by looking at it from the view of somebody who's actually in the trenches, dealing with many countries that would be categorized in as high growth economies, and has dealt with the issues that they confront and how it impacts the markets, how it impacts their societies and politics. Needless to say that this is a very important global issue, although we often are focused on security issues, on foreign policy issues, particularly in Washington. But the tremendous transformation that has happened in the global economy because of the emergence of high growth economies, mostly from the developing world, is probably the big story of our time period in many ways. And we still are grappling with what it means and where this trend will lead. Many of our students here at SAIS are focused on this topic, and they pursue careers in this area, and therefore it's particularly opportune to hear from Arif Naqvi, who's a leading thinker and practitioner in this area. I will leave the full introduction of Arif to Afshin Molavi, who among many other roles he has at the New America Foundation at Oxford Analytica, is also a fellow at the Foreign Policy Institute, at the Foreign Policy Institute here at SAIS. He's also a SAIS alumnus, so it's good to have him back here. Afshin has also written on this issue, has worked on this issue, and is a leading thinker on many of these issues, both in what he writes and in the work he does. And with further ado, let me turn the floor over to Afshin.
Thank you, Vali. It's my pleasure to be here. It's great to be back at Johns Hopkins SAIS. As Vali noted, I'm a fellow at the Foreign Policy Institute. We're devoted to uniting the worlds of scholarship and policy to find pragmatic solutions to the big issues of our time. I can't think of a bigger issue than the rise of emerging markets, the rise of a global middle class, the rapid urbanization of the world that we're witnessing today, and we can't have a better speaker to discuss these issues. Arif Naqvi is a pioneer in the truest sense of the word. We use that word a little bit too liberally sometimes, but Arif Naqvi is a man who embodies the spirit of the growth markets where he invests, who hails from those markets. He's a child of Karachi, Pakistan, studied in London, the London School of Economics. We won't hold that against you here, Arif. He built a small private equity firm in Dubai in 1994. In many ways, he saw the future, but when he built that private equity firm, he did it with $50,000 of his own savings. Now, when we think of Abraaj today, we think of a major global growth investor worldwide. But in 1994, it was one man, one idea, and one conviction. And that conviction was that the fundamentals of a growing middle classes, rapid urbanization, meant that there was actually investing to do in the Middle East and North Africa region. Now, today, Arif Naqvi is the chief executive of the Abraaj Group, the world's leading investor in growth markets with some $7.5 billion in assets under management. Abraaj has 33 country offices spread across 6 regional hubs: Bogota, Dubai, Istanbul, Mumbai, Nairobi, and Singapore. It's truly a powerful global platform for emerging and growth markets investing. Now, the last sentence I said, Arif will have a problem with. When I first met Arif, he said, Afshin, if we're going to be friends, you have to stop calling them emerging markets. These are growth markets, and he'll tell us why. But Arif is a true entrepreneur. How else can you explain his reaction to landing in Saudi Arabia in 1990 to take on a new job? And his first reaction was, I'm here in Saudi Arabia. The very next day, the Gulf War began. And what did Arif say? Said this timing was perfect. It was ideal to look for innovative business opportunities. In 2002, he began Abraaj Capital. Again, a year earlier, we had the horrible events of 9/11. But Arif Naqvi saw the fundamentals, and he also understood keenly the importance of looking at individual countries rather than regions. I mentioned Arif Naqvi's business success, but it's important to remember that he held the view from the very beginning that the firm's investment and the ethos of the firm should strongly support the social good. And for this investment philosophy, in practice, he has been named a board member of the United Nations Global Compact by UN Secretary General Ban Ki-moon, and he has received the Oslo Business for Peace Award, which is the highest form of recognition given to an individual leaders for fostering peace and stability through creating shared values between business and society. He's not only the first chief executive from the United Arab Emirates to receive that award, but he's also the first guy from private equity to receive that award. He is the recipient of the Sitara Imtiaz Award, the prominent honor awarded by the government of Pakistan, and in 2008, Mr. Naqvi and his family established the Aman Foundation, a social sector enterprise in Pakistan, which supports sustainable developments in healthcare, nutrition, and education. He sits on numerous boards, many not-for-profits, many of which support entrepreneurship in the global growth markets he knows so well. So without further ado, let me turn it over to Arif Naqvi.
Thank you very much. Those were very kind words, and often I didn't recognize myself while you were talking about them, because the way I tend to look on myself and the work that I'm privileged enough to be doing is it's very much work in progress. And when you talk like that, it's almost like somebody's giving me a report card, and I'm always waiting for the next sentence that says "but." So very much work in progress, and very happy to be doing it. Thank you very much for having me here today, because it's particularly topical, and it's particularly interesting that you should be having this debate at this time in this city, and around the whole question on the need to shift the perspective away from developing nations to what I call growth markets. And it's particularly important and interesting, and I'd like to start off on an intentionally provocative note by saying that this town in particular, and people that drive policy in this town in particular, need to change the way that they view the countries that are occupying large parts of the Southern Hemisphere. And I say this as a person who, by the way, is pretty much completely aligned to the way American foreign policy acts on a global basis, and someone who believes in America's leadership. And yet I find that I am increasingly becoming isolated in my world when I sit and defend some of those interests, because too often policymakers in this town and elsewhere as a result in capitals in the Western world look at the lens through which these countries that occupy the Southern Hemisphere. They look at it either through a security lens and security perspective or an aid perspective. Now, countries in Asia, in Africa, in Latin America, the Middle East, and Turkey are often seen as a place where terrorists live, conflicts reign supreme, or people starve. Of course, there is significantly more to these markets than just that. I would like to challenge people to move beyond that mentality. Many of these countries arguably are danger zones, but most of them are not. Most of them are developing markets, and most of them have gone past that phase and are actually what I call growth markets. For example, Nigeria today is one of the top 10 countries in the world for LVMH Hennessy. It's outranked and gone past countries like Canada and Mexico in terms of the demand they generate. Colgate, Unilever, Coca-Cola, you name the business that emanates from here, and its biggest markets are in those very same markets that unfortunately are being viewed through the wrong lens. And this is the shift that I wanted to talk about with you today. It doesn't mean that there are no problems. It doesn't mean that there aren't security issues in these markets. And it doesn't mean that development does not have a vital role to play. But the principal trend that we are living through today, and the one that history books are going to remember not 200 years from now, 100 years from now, 50 years from now, is going to be that these countries are part of one of the great socioeconomic shifts of human history. not just the last century. And these shifts happen once every few centuries. And if we continue to approach these countries without putting a mindset on that is business and commercial in nature, we will miss out. And eventually, maybe not today, maybe not tomorrow, but we're going to get left behind in our thinking in terms of how we view these markets. The year I was born, in 1960, the total capital flows from north to south amounted to about $8 billion. 60% of that total was developmental money. In 2011, the total flows have grown to a level of about $500 billion. That's an increase of more than 60 times over the last 50 years. And FDI has increased at almost twice that rate. And developmental assistance, by contrast, is only a quarter of that total that we're talking about. In virtually every country of the Southern Hemisphere, FDI has lagged at close to 20%, has increased at close to 20% since the year 2000. Every country, every region has grown at this rate, except Africa, where the rate of growth is a little bit lower at 10%. This is a very, very clear indication that the world has shifted. The world no longer sees these countries, the business world, no longer sees these countries as developing countries, but as commercial marketplaces. Even the phrase emerging markets, as a result, is slightly outdated, because emerging markets is not really the right way of describing China, which is shortly about to become, in months, if not years, the largest economy on the planet. And this is a very, very important point, because the more you refer to it as emerging markets, I feel that's a little bit patronizing in terms of the term and the terminology that is used. Now, why has this transformation happened? If you think back as recently as 1980, these markets that I'm talking about were growing at half the rate of the so-called developed world. And by the mid-1990s, these markets had started to grow at 3 times the rate of the developed world. And it's important to emphasize this is not a temporary blip. This is not an accidental moment. This is capturing one of the great transformational moments in human history. And this only happens once every few centuries, because if we go back and zoom back, not just to the last 30 years, but we go back in time to the mid-1800s, the same thing was true then, which is that these markets occupied the majority of the global marketplace. And when that was happening in the mid-1850s and 1860s, the United States at that time was in the midst of a crippling civil war. And those markets were growing, but that was Asia. Today it's no longer just about Asia. It's about Asia and Africa and Latin America as well. But interestingly, back then, when the US came out of the Civil War, the world allowed the US, which was at that time an emerging market, to transform itself and become the leader of the global economy as well. And that was a transformation process because the US was ready to innovate and change and re-identify with the means of production that were available to it at the time. What I am really getting to when I discuss all of this is that not only are we witnessing the re-emergence of growth markets, not only are we talking about bending back the arc of history, what we're talking about is that this time round it's a very broad-based shift. It's a shift that encompasses most of the countries that are in the Southern Hemisphere. Most of these countries have a series of things happening within them that are transformational in nature. And when I say that, what I mean is that, as we all know, we're in the midst of mankind becoming an urbanized race. More than 50% of us today live in cities. And interestingly, that population is increasing at the rate of 1 million people a week. That population is moving into cities primarily in what the world refers to as emerging markets at the rate of the equivalence of 8 New York cities a year. Now, that's a massive number of people moving into cities. And that, in turn, is itself leading to an enormous amount of opportunity, both economically, politically, and from a transformational perspective in all of these markets. The rate of growth that these markets are experiencing is also significantly greater than the rate of growth that is being experienced in the so-called developed markets, more than 2 or 3 times the rate of growth. And in a short period of less than 20 years, 19 of the world's 30 largest economies are going to be coming from these markets. 3 billion people are going to be joining the global middle classes, most of them coming from these markets in the course of the next 20 years. In just the next decade, we're going to see another 1.5 billion people entering the ranks of the middle classes. Now, that in today's terms is 40% of the entire planet's population. It's 3 times the size of Europe and the US. I'm giving you these statistics and just giving them to you in the scale and quantum that I experience them, because this is a shift. This is an inexorable shift. Politics is not going to stop it. Demography is not going to stop it. It is the desire of so many people that are out there to want more of everything than they currently have. And interestingly, this is an upward shift of a large chunk of humanity in terms of moving into the middle classes. And it's going to change the geography of demand. It's going to change the geography of consumption and of consumer product manufacturing. Global demand from these middle classes alone is going to double from $21 trillion to $56 trillion in the next 2 decades. And 80% of that number is going to come from these so-called emerging markets. I hope you're getting a bit of a sense of why I no longer call them emerging markets. These are the growth markets. Coca-Cola is spending 2/3 of its global capex in these markets. Unilever is building 19 out of 21 of its current factories that are under construction in these markets. Major corporations around the world have understood that what sustains their share price in their domestic markets is growth coming from these new markets. And the drivers of this growth are both the urbanization, the rise of the middle classes, and equally the way in which these middle classes themselves break down. And I'll take you into that journey, if you permit me, just very briefly. These 2.6 billion new urban residents that are going to be living in cities in the course of the next 2 decades, okay, there is not just the current large cities, they're the tier 2 cities that we need to focus on as well. The cities that we haven't heard of today. McKinsey and Bain both estimate that more than half of global growth is going to come from close to 400 cities, the majority of which are minuscule today in proportion to where they're going to get to. And why is this so relevant? Because a fact of life is that cities are at the center of modern economic life. Life as we know it today centers around primarily city growth and urban development. And throughout history, no country has achieved middle class or middle income status without a significant population shift into cities. They contribute disproportionately to national GDP, national self-reliance, national feel-good factors. So for example, today, if you look at Nigeria as a country, and we say that Nigeria is growing at 4% per annum, you can bet your bottom dollar that at that point Lagos is growing by 8%. If Indonesia is growing by 6%, Jakarta is growing by 12%, because the disproportionate contribution of capital cities in these markets is also something to bear in mind, because that's where the majority of the growth is coming from. Today in Turkey, 10 cities contribute 75% of that country's GDP. Cities in Mexico, in Peru, in Colombia, and in Chile are contributing 65% of the GDP growth in their domestic markets. And in Africa, GDP and consumption growth in the cities is going to dwarf anything else. The population of Africa is going to grow from 1 billion people to 2 billion people. More than 60% of these people are going to be living in cities. A large chunk of Africa is going to be moving into the middle classes. Unfortunately, most of the world today still continues to think of Africa as being a resources story. Well, I'm here to tell you that Africa is actually not just a resources story. It's actually a middle class story. It's a consumption story. And that's where the biggest opportunities in Africa are going to increase and come from. Because as they learn to live with each other, even today it is easier to fly from one African country to Paris to come down to its neighbor than it is to move between each other. These are the opportunities. These are not barriers. We can look at them as barriers in the context of how governments relate to each other, but when business looks at it, these are the opportunities of how we can continue to develop the economic opportunity that is prevalent in those countries. Now, I've talked about already the rise of the middle class in these growth markets, and again, within that, the point that most people miss is that there are two trends within this middle class growth. First, people are moving into the middle classes for the very first time, and often at the lower levels of the middle class. And then people are moving up within the middle class, those that are already there and are attaining a higher level and a higher status of ability to spend their discretionary income. So for example, by 2020, and these statistics are not just through one research institute, they're by and large consensus numbers that I'm quoting. By 2020, 60 million Africans will have moved into the upper middle classes. And that means that there is a significantly higher demand in Africa for the consumption patterns that are driven by that level of affluence. So cars, televisions, financial products. At the same time, in the same continent, 350 million people will be moving into the lower middle classes for the first time. And that means there's going to be an increase in demand for affordable goods and services such as packaged goods, snack foods, microinsurance, and microfinance. And if you take an example of a country like Turkey today, forget about going forward in the future, the middle class, as I mentioned, which is living in those cities, is already encompassing 75% of the population, and it will continue to grow because the per capita income in these markets is growing 2 times faster than that of the OECD countries. And here the story is therefore about consumption and demand. And the interesting thing that we need to bear in mind at this point is when we look at the age of the populations. And this is really the crux of the point that I wanted to come to. We talked about urbanization, we talked about the middle classes. The most amazing trend in these markets is the youth of these markets, is the youthful age of these markets. These markets are very, very young markets. The median age is 26 in these markets. That's almost half the age of the world that you live in. Average age in certain countries, like Nigeria, is even lower. The average age of Nigeria is 19 years. So imagine and think of the potential, both for good and bad, that can result by having a number as low as that. This is more than just being a social issue. It is critical to economic growth, because growth markets all have this in common demographic dividend, which is based on low dependency ratios. And low dependency ratios compared to developed markets. Now, if you take the case of India versus China, India has a much lower dependency ratio than China has, which for the Chinese, it's going to become a bigger problem as we go forward into the future. And age also matters because it's totally correlated with consumption. Spending tends to climb in your teenage years, increases as you go through your college years, and peaks around the age of 40. It's when young people up until that point are out there spending money on consumption, on building families, on buying houses for the first time, buying cars for the first time. So therefore, the younger the average age, the more the consumption pattern and the more the ability to grow forward in the future. The best way of describing it, and to put a fine point on it, spending, if you remember, I told you, peaks at around the age of 40. That is exactly the median age of the developed markets of the world, of the OECD countries, of the majority of the G20 countries. That is the age that we're currently finding is the average age, which is 40. So you can see how consumption, even in these economies, and growth that is coming into the production facilities in these economies are being driven by those markets that are out there in the so-called emerging markets. And all of this is creating an enormous opportunity, an enormous subset of creative talent that is being unleashed in these markets. From the demand for infrastructure, infrastructure-related businesses, financial services, logistics, education, healthcare, you name it. The opportunity is around growth in these markets. And this is where the majority of consumption patterns are going to be spent as well. Consider this, financial services in Africa. Less than 3% of the population of Africa has a credit card. Only 25% of the population of Africa has a bank account. And on a per capita basis, the US spends 300 times as much on insurance premiums. Now, interestingly, at the same time in Africa, mobile telephony and the use of mobile telephony to develop spending and online procurement of products is significantly higher than anywhere else in the world. If you think about the fact that there are less credit cards in all of Africa than there are in just Italy, you will see where the opportunity is. Actually, that's also an opportunity to solve a problem, because if you move all the Italian credit cards to Africa, then you'll solve the national debt in Italy, and you get the point that I'm trying to make. And that's where the opportunities are, and that's where, from water treatment to desalination to roads, bridges, highways, trillions of dollars are going to be spent in these markets going forward in the future. Now, I think I've made the case for the economic element of what needs to be done, the money that is going to be spent, the opportunity that's out there. But at the same time, there's also risk. Let's not forget that. There is the risk of governance. There is the risk of markets not performing the way they're meant to. The fact that South-South trade is higher today than it's ever been and is significantly greater than North-South trade today. These are all opportunities, but there's also, obviously, the risk element around governance, around corruption, around lack of transparency. All of these things are going to get resolved. The way we were looking at the world 15 years ago from a corporate perspective, it's very different today. And these opportunities are here to stay because the population growth and the urbanization and the youthfulness of the population, the demand factors that are out there cannot be put down. And yet, when we look at risk from these markets, we tend to look at it with, we paint all markets with the same brush. And it's what I call headline volatility. I mean, in the last 3 months, the same newspaper in this country, which is followed by many, many people, had a headline that said emerging markets are doomed. And then the next thing, 3 months later, when I came back here, I saw how they were prophesizing the return to growth in these markets. And all caused by what? A comment from Mr. Bernanke saying that quantitative easing is going to go away. Now, this is a fact. There are some markets out there that have benefited enormously from lax credit. But I'm not talking about an individual 3-monthly or 6-monthly movement in stock markets or in issues caused by QE, quantitative easing. This is going to happen. There's no two ways around it. Of course, there will be a reduction in the availability of credit and easy money. But the long-term trend lines and the long-term implications of what I'm saying are here to stay. And we have to change our risk models. We have to change the way we look at risk. Because you know what? When risk came, frankly, we never thought about it. But when risk came, it came from right here. It came from Wall Street. And it came from the global banking system. And it came from the fact that we were all focused on greed, all of us. And the reality is that 5 years later, we have kicked the problem somewhat down the road. We have brought the issue out of focus, but we have not changed the parameters by which we view risk. And all of this, and I'll stop here, all of this against an incredible social trend as well, which is that society has brought inclusiveness to the youth on the planet for the very first time. Society doesn't realize it, but youth is dramatically more empowered today than it has ever been in human history. And it's done so partly thanks to social media, partly due to the fact that youth today is operating on a community basis. And it has more in common across national borders than it has with the hierarchies in its own countries. And because of that, it is going to change the way the world is governed. It is going to change the way we think. And it is going to change consumption patterns because youth across the world watches MTV and looks at Coca-Cola ads. And everyone is going to want more of everything. And within that is the seeds of opportunity. And that's why I think that the markets I live in, the world I live in, needs to be looked at through a completely different prism than one that is prevalent in this city, which is around security, aid, or issues relating to terrorism. There is a lot that is happening out there. which needs to be understood and which needs to be developed and harnessed. And I think that in itself will also solve a lot of the security issues that we face out there. So that's part of what I wanted to say. Happy to talk more. Thank you.
Thank you so much, Arif. You really made a compelling case. It was a necessary palliative to some of the emerging markets doom and gloom stories that we're hearing. I remember when I was in Dubai a couple of years ago, someone said to me, it's Shanghai, Mumbai, Dubai, or goodbye. That was the mood. But you've invented an acronym, MENASA, Middle East, North Africa, South Asia. And the important thing is that you see the world sort of geo-commercially. Now, there's another acronym going around in the region, CHIMEA, China, India, Middle East, Africa. Speak, if you will, about the importance of China in these growth markets. And, is this argument that if we see a China slowdown, we're going to see an emerging market slow down as well. Speak, if you will, a bit about that.
China is a crucial component of the global growth that we are all sort of almost hoping is going to continue to happen. I remember in 2009 in Davos, the Chinese Prime Minister came for the first time and he was giving a speech. And I can tell you that of the 2,500 people that go to Davos, each of whom is extremely pompous and thinks they're the most important people on the planet, right? And every single one of these people was sitting there with absolute pin drop silence and were occupying every bar, every meeting space, everywhere the TVs were on. And when he said China is going to grow at 8%, it was like children bursting out into, in happiness. People were hugging each other saying, he's gone and rescued us. The reality is China is a crucial component of global growth. Whether we respect the numbers and the data or not, a Chinese slowdown is going to have an impact across the global economy. But I think China today is actually operating off a very wise platform as well. They also read the same headlines as the rest of us. They also understand the value of the consumption story. But I don't think it's right to paint everything with the same brush. So for example, even if you have a Chinese slowdown, you have other countries in ASEAN, which are extremely strong. The integration of ASEAN that is happening this year in 2015 is going to lead to enormous opportunity in Southeast Asia. I think Africa is largely decoupled from what is happening elsewhere in the world, and the opportunities there are substantial. So I don't think everything can be painted with the same brush. Just like if you have the reduction of QE, then everybody says, well, all emerging markets are about to slow down. Well, Turkey may slow down because of its current account deficit. India may slow down. Indonesia may slow down. But Colombia is not slowing down. Mexico is not slowing down. Thailand's not slowing down. So it's wrong to paint everything with one brush. And it's equally wrong to assume that any one country is going to have a determining impact on what will happen across the globe.
Well, let's turn to one of the other BRICS, India. You saw that Walmart just announced that they're pulling back from their big investments in India on regulatory matters. When you've been in that market for many years, I mean, is that the big obstacle in India, is the regulation?
Well, I always tease my Indian friends with the fact that nobody from outside India is ever going to make money in India till the Indian businessman hasn't finished getting rich. Okay. And it's been the same story in almost every market in the world. I mean, at the end of the day, you witnessed enormous dynasties and fortunes being created in this country before it opened up to foreign investment as well. The reality is that India is a very difficult regulatory market, but India is also one of the great opportunity sets on the planet, because if they can get their governance right and their thinking right, especially around infrastructure, the amount of investment India needs in infrastructure today dwarfs the needs across the rest of the planet. And I think that India, once it works out its basic governance model, is going to be an enormous destination for foreign capital.
Well, and you've talked very convincingly about the South-South revolution that we're witnessing and the growth markets revolution in many ways. What about the South-North, in the sense that if you look at, for example, the purchase of H.J. Heinz and Company, the news was that Warren Buffett, played the leading role in this, but it was really some Brazilian private equity guys who led that purchase of H.J. Heinz and Company. And the CEO of H.J. Heinz said that it used to be that we would go prospecting in emerging markets, and now they're coming and prospecting here. Everything from Tata owning Jaguar, and all these stories of Chinese Geely owning Volvo, and So how much more of that are we going to see? Some
I
of
think
the big emerging multinationals really making an impact in the West?
So I heard a presentation recently where they were looking, where the presentation was focusing on the Fortune 500 companies and how many 15 years ago or 10 years ago were from the US and from developed markets and how many were from so-called emerging markets. And if it was 80% 10 years ago, it is now 30%. There is a rising increase in terms of global companies that are coming out of China, out of India, out of elsewhere from the emerging markets. I think this is a trend that's not going to stop. And I think globalization is dictating that you are sort of integrating backwards, both vertically and horizontally. So I don't think there's going to be any slowdown in trade either way. I think the opportunities that are being thrown up, and you have to think back to the example I was giving of Coca-Cola and Unilever and everybody else, these businesses aren't blind either. They also realize where the opportunity is, and they're making massive investments as well into those markets.
Okay. Well, I have to ask you, we're sitting in Washington, D.C., just a few blocks from the White House, a few more blocks from Capitol Hill.
He doesn't listen to me,
Yeah, he doesn't listen to you. What are you seeing when you're seeing this government shutdown? When you're seeing what you're seeing in Washington, how does that play in emerging markets?
I have to tell you with a bit of bemusement,
Yeah.
that you can do this to yourself, even in the United States of America. Yeah. But I don't think that the rest of the world is giving it as much prominence as you are giving it here. Obviously, it's your economy, your country, and your shutdown.
Right.
But in no way is it impacting the terms of trade of the rest of the world versus the U.S. No.
So, and you're not too concerned.
I'm not
about
too concerned.
A default or no. Okay. All right. Let's go back to your origins in a sense.
A default, if it happens, is going to throw up enormous buying opportunities.
There you go. There's the entrepreneur. Yeah. There you go. Well, let's go back to your origins in the Middle East, North Africa region. Now you're a global investor, but I'd love your thoughts on how you're navigating the Arab uprisings. Do you feel the old Warren Buffett adage holds here: when others are fearful, be greedy?
It's a particularly confusing trend. And as we were talking earlier, this confusing trend is that we were too quick to provide labels. We called it Arab Spring before we knew it was a spring, okay? And now we're very happy to call it the Arab Nightmare, but it's not quite the nightmare either. We have to remember that this whole process started with one man who set himself on fire. I don't know how many people here will remember the name of that man. It was Muhammad Bouazizi, for you to sort of recall back, because it was very important. We must remember his name. He did not burn himself for political reasons. He did not set himself on fire because he was upset with the government of Ben Ali. It was a pure and straightforward economic issue. He could not provide food for his family. Now, if you think back to that basic micro trend, and you think what has changed in the Arab world, from then till now, the answer is a sum total of zero. Nothing has changed. The people that were disadvantaged are still disadvantaged, not just in the Arab world, but everywhere where we can potentially foresee that a problem will take place or a problem will occur. We have not yet begun to address the root causes of what happened then. And so my view of when I look at the Arab world and I look at Arab Spring and so on, is at the same time as we are having these political changes and the economic stresses inside these economies, some of these economies, we have to remember there are 100 million Arab youth that are going to be needing jobs in the next 20 years, and those jobs are not being created. It is a problem that goes back to education. It is a problem that goes back to the economic model of small and mid-cap enterprises. It is a problem that goes back to entrepreneurship. And all of these issues that were there 10 years ago are there today. We have another overlay on top of that, which is really the big defining trend, which is political Islam. Political Islam has raised its face and is there to stay. And certainly in the context of the 4 or 5 main operating powers, let's call them, in the Middle East region, each of them is representing a brand of political Islam that is diametrically opposed to the other. So we're also in the middle of a theological shift around there. So I don't see that this is going to get solved in the next 5 or 10 or 20 or 30 years. I think it is going to take a fair amount of time before these issues are resolved. Within that, of course, there will be opportunity around infrastructure. There will be opportunity to transform economies by focusing on things that matter, like vocational education, which is crucially important, by providing means of sustenance and so on. But I don't see the political issues resolving themselves very quickly.
And take Egypt, for example. Are you looking at Egypt? Are you looking at investment opportunities in Egypt? Yeah,
absolutely.
So you see that the long-term fundamentals remain sound.
I think the long-term fundamentals in Egypt have remained sound all the way through the process of the first revolution and the second one. When we look at businesses that we owned in Egypt, we were surprised actually to see that across 10 or 12 companies, the average growth both on revenue terms and EBITDA levels was somewhere between 20 and 30% on an annualized basis. Never stopped all the way through that process. So Egypt as an economy is continuing to grow.
And are we, in a sense, starting to see two Middle Easts? I mean, there's the transition states in many ways, and then there's the states in the Persian Gulf region, ex-Bahrain, who seem to be watching the Arab uprisings from their flat-screen TVs and their air-conditioned villas, right? I mean, are we witnessing kind of two Middle Easts emerging?
There have always been two Middle Easts, and I found it very interesting that you called it the Persian Gulf.
Yeah.
Because, you know, had this conversation been taking place in Dubai, it would not quite be the Persian Gulf.
Well, there's several Iranians and Iranian Americans in the audience. I didn't want to be taken out afterwards.
Guys, let's just agree to call it the Gulf. I mean, you know, what difference does it make what we call it?
No, but talk a little bit about Dubai, your base.
Yes.
I mean, in many ways, it is this, you know, is Dubai in a sense a silent partner to Abraaj? Could what you have been done without Dubai?
You know, I think one of the reasons for our so-called success in what we're doing is because we are local in almost every environment in which we operate. And as you mentioned earlier, we're operating in 30 markets from Latin America to Southeast Asia. And what we've understood is that unless you are local, unless you don't understand the ramifications of what it takes to be a Nigerian in Nigeria, not a Nigerian in London with knowledge of Nigeria. You have to be very local in the way you think. And the more local you are, the more the local system adopts you and embraces you, because they like the idea that you are in it for the long haul. So, you know, to me, one of the most important things about having been in Dubai is a cultural home for entrepreneurship. It's strange that in the middle of the desert with no oil, with no real sort of inherent natural advantage, Dubai has prospered the way it has. And I think it has because it's been all things to everybody. The Indians and Pakistanis think of it as an extension to Mumbai and Karachi. The Saudis think of it as an extension to Riyadh. Everyone embraces it as home.
The Iranians
think
of it as
absolutely
the best city in Iran.
Best city in Iran.
Yeah.
And in a sense it actually is, because it is the mechanism by which Iran trades with the world.
Right.
And to me, it has, because it has succeeded in being all things to everyone, it is really the shining example of globalization that we have out there today.
Right. And so I want to take some questions from here, but before I do, I'd like you to talk a little bit about social entrepreneurship and what you've called private equity 3.0, I think. If you could tell us a little bit about that concept.
So I live in a world. Let me take a step back. The private equity industry globally is known for its greed. Okay, and the private equity industry globally is known for the fact that it makes a lot of money for very, very wealthy people, because there is a threshold and a benchmark beneath which it does not go. For example, it doesn't appeal to retail investors. So it has always had this halo effect that those of us that practice it are a bit of alchemists. We stick our hands into this box and we turn base metal into gold. And for a long time, the industry succeeded on the back of allowing this myth to be propagated. The way I've always looked at private equity industry is it can be an enormous force for social good. And it can be an enormous force for social good, not just because we buy and sell companies, but because we operate in ecosystems. We operate across communities. So from the day that we started Abraaj, we've had a very focused approach to this, in that we have looked at our ecosystem as being a stakeholder ecosystem. We've always embraced the communities in which we operate, the thinking in which by which we are known. From the very first day that we started, we decided to put 5% of our top line, not our bottom line, into sustainable and stakeholder engagement-driven processes across the regions in which we operated. As a result, we were fortunate to have been able to disperse actually numbers that run into $100 million into communities and into causes around entrepreneurship, around education, around employment. And what that means is that when you do it on a sustainable enough basis, communities will tend to embrace you. And they will realize that you're not just there to make money, but you're actually there to achieve good. And that is what I mean when I say private equity 3.0 is about engagement across communities, and it's about being able to make a difference, not just in profitability terms, but touching everybody you come into contact with. It's not a Mother Teresa model. It can be done. And we're proving that it can be done. And one example I'll give you for at this point is this utility that we acquired a few years ago in Karachi, which was a monopoly. It was a utility that was serving 20 million people and was one of the last integrated utilities left on the planet, transmission, distribution, generation. And yet when we bought it, it was the most broken company in the country. It was, the city was going through 18 and 20 hours of shutdowns of electricity per day. And we realized that, anything that we did would enhance it. And today, 4 years on, we've transformed the company. We've changed the way it operates. We've added 1,000 megawatts of electricity. We've done so with the support and engagement of the community by doing things that brought them into and a part of our issues. And today, it's one of the most loved companies in the country. It's the subject of a Harvard Business School case study. Actually, Harvard Business School and the Kennedy School collaborated together to produce this particular case study, which is the first time they've ever done it, surprising in itself. But it can be done, is the point I'm trying to make. It can be done because in economies like the ones in which we operate, your ability to do social good and make profitable investments can go hand in hand.
Very good. Thank you. Thank you for that. So let me turn to, please, over here.
Hi, my name is David Bloom. I wanted to ask you something about entrepreneurship, which you were just talking about, but more on the business side. It's obviously been a pretty strong policy priority for many governments. You've seen efforts to streamline regulation, make it easier, remove barriers. You've seen efforts to increase public funding, public-private funding, and I think some of the results have been a bit lacking. What do you think, from all of your experience, what else could be done to increase not only entrepreneurship in general, but more of a move towards sort of knowledge economy entrepreneurship rather than more of the remedial side?
So I think, too often we kind of sit, and especially in markets in which I operate, we tend to rely on government as being the answer for everything. And we give it too much of a role and a preponderance in terms of center stage in being able to make an impact at a policy level. I think until the private sector engages in issues, they don't generally get resolved. Until banks don't make commercial funding available to startup enterprises, it won't happen. Now, you live in a country where entrepreneurship is embraced, okay? In this country, entrepreneurship is embraced. Failure is often celebrated. Bankruptcies are tolerated. In large elements of the world outside, bankruptcies are a social stigma. Failure to make a payment results in a jail sentence. Okay? Laws have to be changed by governments, but then the private sector has to come together and embrace that and make more and more opportunity available to people that want to pursue entrepreneurship dreams. It's not being done in a coherent enough manner. And the problem is that the large multilateral organizations like the World Bank, like the IMF, like the IFC, and the regional development banks, this is a space for them to get involved with, and they're not doing so.
Please, over there.
Hi, good evening. Thank you for your presentation. My name is Nicolette Maunganit. I'm a MA3 or second-year student here at SAIS. I just wanted to ask if you would mind sharing with us what your conversation, the content of your conversation would be if you were addressing the leaders of some of these growth markets, because obviously from the outside looking in, there's a lot of opportunity and, for potential investors, but how would you advise these growth markets to best prepare themselves in terms of institutions, in terms of political systems, in terms of just their perspective and their plans for the future, their forecasting for, in each of these countries? How would you best advise them to prepare for this growth?
So I'm a very, very strong proponent of and believer in the fact that large enterprises must have a foreign policy, okay? So we, for example, at Abraaj have a corporate foreign policy. The minute anybody operates across boundaries and borders, you have to have that, because without that, you don't have the clarity of self. You don't know what you stand for. People like us actually engage with governments all the time. I'm very fortunate in that I am constantly involved in dialogue and debate with leaders in all of these countries. Sometimes we offer unsolicited advice. Often we offer advice that is disregarded. Okay? But always we tell them what we think the right outcome and attitude and approach should be. So for example, when we look at entrepreneurship and SMEs, I'll give you a simple example. If you take the approach to SME development, which is the cornerstone of employment and growth in any economy anywhere, okay? When you look at the way subscale economies operate and they try their best to spur SMEs within the economy, and you look at, for example, Mexico and Peru and Colombia and Chile operating independently with their schemes, what if all of them were to come together and operate one? What if all the countries in the Arab world were to come together and operate at scale an approach to entrepreneurship and SME development? It would no longer become a national priority, it would become a regional priority. Which is why I am a big believer in the fact that things like the African Development Bank, the Islamic Development Bank, the AFDB, all of these entities have an enormous capability to pull regional governments into a thought process around whether it's vocation, whether it's education, whether it's vocation, whatever it is. Yeah? If you bring enough countries into it, you get scale. The reason why venture capital succeeded in this country and why entrepreneurship succeeds is you have a potential market of 350 million people, right? So you can start with an idea and 100 ideas may fail, but the one that does so because it is scalable. In any one of these markets operating in isolation, you don't have that scale. It's only by coming together. So I am a big believer, and I actively work with and talk to governments around the need to change laws, the need to, for example, remove taboos around bankruptcy, around penal solutions for bounce checks, which is, you'd be surprised how many countries in the world that continues to be the case in, and so on. So it starts at the most basic level, but you can't stop talking to them, and you've always got to give them parallels, saying, you may be Mexico, but look what happened in Thailand, look what happened in Indonesia, look what happened in Malaysia. And you'd be surprised how little they actually know about it. You'd be surprised how within their little bubbles and their little ecosystems, very little information permeates into them. So it's very important to keep talking to them rather than the sycophants that are constantly telling them how incredibly cool they are. Every minister thinks he's remarkably cool.
And particularly here in Washington, you had touched on this in your talk, but you know, we kind of view the world through a geosecurity and geopolitical lens. And I think one of your colleagues who used to work for the government said that when he worked in the government here in the U.S., when he looked at Pakistan, he would see problems. But as a private investor, he sees opportunities. And I think that's the main difference. Please.
Vladimir Nikarov. Back a little bit on the business side. As you know, the three key components of private equity is financing, restructuring, and exit.
And?
Exit strategy. So in US, a lot of the emphasis is on the financing, high leverage.
Yeah.
Restructuring plays a small part because a lot of companies already operate pretty well. Sometimes actually people claim that private equity destroys companies, and the exit horizons are usually 6, 7, 8 years. How is that different in the developing world? Sort of how those three components are different? That would be interesting to know.
So it's a great question because it's almost exactly the opposite. All right? Because in the world, across that world, financing solutions are not readily available. global international banks are reluctant to lend money. Domestic money is pretty expensive. So it's not just about having access to credit, it's about what you can do with the companies. If you think back to the entire hypothesis that I was articulating around the growth opportunity, the real opportunity in those markets in PE is to take the country champion and make it into a regional champion, into a global champion. The ability to scale. So your ability to influence outcomes has to be driven by the mindset of having operating skills, of having value creation at the core of your business model, not financing solutions, okay? And it's a completely different business. So we are much more hands-on, we're much more focused on business development and finding opportunity. And because at the end of the day, when people look at these markets, they say, my God, it's tough to navigate, and there's corruption, and there's lack of transparency, and there's this and there's that. My answer to that is I need to find 5 companies in Nigeria. I need to find 7 companies in Kenya and 4 in South Africa. And when I add on a few more in different countries, in 30 investments, I can deploy $1 billion into Africa and triple that money, right? So the opportunity is very clearly definable.
The holding period that you're targeting and the exit strategy?
The holding period typically is anywhere from the same 4 to 8 years. So there's no real difference there. The great thing is that if you play the game the way that I've just outlined it, then you have all sorts of global enterprises that want to buy that asset, right? Because they want to get into that market. If you think about our business today as Abraaj, we operate in 33 economies that are vibrant and growing around the world. We have local people, 300 local people in those markets, hands-on, domestic. Now, if you think about how much animosity that would create to a firm from the outside wanting to get into those markets, well, they can't get into those markets in a sense because we're kind of there, right? So it's a good place to be.
Please, over there.
For just one last question.
Okay, in the back over there.
Thank you very much. Great talk. I'm a real estate developer here in Washington and dealing with mostly U.S. institutional investors. Over the years, I've tried, unfortunately unsuccessfully, to raise capital from the Persian Gulf or the Middle East to invest in the U.S. And most of the time, one reason I've been given that they weren't interested, other than taxes and other issues like that. But really, it was the argument was that, oh, we're making so much more money, a much better return in our own neck of the woods. Why should we come to the U.S.? And every time I try to explain the concept of diversification and political risk, it seemed a completely non-starter. And political risk to them, what wasn't an issue. As an investor dealing in developing part of the world, how do you view political risk? I mean, do we as Americans think too much of it? Because I would imagine most U.S. institutional investors would want a significant premium to invest, in Africa than in the U.S., for example. I mean, are the U.S. Or the Western investors unrealistic, or are the developing world investors, more gung-ho than they should be?
I think it's all a case of the comfort zone, isn't it? And in a sense, both sides, when you put it in when you frame the discussion like that, both sides are right and both sides are wrong. I don't think that you have any sensible investor in the world today who does not take a fairly diversified approach to investment strategy. There isn't anyone that I know of that will not have some money in emerging markets, stroke growth markets, some money in the public markets, some money in the West, some money here and there. That diversification of the portfolio approach is something that we've all been taught and everyone has embraced. That's a starting point, right? The real issue that I find is that when I look at a region, for example, the Middle East, okay, and I look at the opportunity to invest, despite the fact that my colleagues and I have been investing in the Middle East for the last 20 years, I've never invested a single dollar in Syria or in Yemen or in Iraq. Guess what? All of them are flashpoints today. in some way, shape, or form. You always go back to first principles. You always try and understand where the governance model is and where it's going. Is the opportunity worth putting the money in? So you have a much more developed sense of political risk if you understand the local players and you're operating in the local market, rather than painting a broad landscape that says everything in that part of the world is dangerous and therefore shouldn't be touched. You can paint that brush and you would have lost out on the ability to make enormous sums of money in Southeast Asia with that approach, or in Sub-Saharan Africa with that approach, right? So my feeling is very much that sensible investors today have a healthy attitude to both risk and a very healthy attitude towards diversification. I think the big trends going forward in the future are that more and more money is going to, by definition, go into assets that yield greater returns. I'll give you a provocative thought at this point, which is, if you spend your entire working career in the United States and you'll end up saving $1 million by the time you're 65, okay? $1 million is a substantial amount of money to the average person working in this country. But guess what? $1 million, if you put it in the bank account, gives you sustainable income of $25,000 a year, which puts you below the poverty line. So you've worked your whole life, you've saved all that money, and you're actually poor, right? So this is the big issue that pension funds in this world are facing today. Should they be looking at returns that beat the benchmark, or should they be looking at absolute returns? When you look at absolute returns, you have to look at alternative assets, and you have to look at industries like ours, which generate those alpha returns that enable them to be able to meet their unfunded liabilities 10, 20, and 30 years out. Okay? So I think as we're going forward, there is going to be a shift in thinking from the word alternative into the concept of equity. Equity will be both public and private, and under that asset class, you will see a lot more money flowing into the world that you occupy and I occupy, which is alternative assets.
Thank you, Arif. So let me just close with this. Maybe you can offer some parting thoughts to some of the students in here who are bright, about to enter the world. Any parting thoughts of those who have an entrepreneurial bent? Is it go east, young man or young woman? What is your final parting thoughts to them?
I think without question, it is go east, yes, because east or south, as I would say. Get into that boat or ship or plane or whatever and come to those markets, because that's where the opportunity is. That's where you will see growth and resilience and opportunity, which you will experience with a lot of excitement as well. But the one thing that I do say to all young people is that your future is so remarkably bright, because the world that you're going to face, yes, it has issues, but the way in which it is changing, the manner in which technology is interfacing in our daily lives, the way in which developments are taking place, I just wish I could add a few more years to my working career, because it's just going to be so exciting. So
thank you so much.
No question about it.
Thank you. I think this was a rare treat. Thank you so much. Thank you. Thank you so much. Thank you. Thank you.